You know the type, right? The superstar fund manager on the cover of a magazine, the Wall Street wizard who promises they have the secret sauce, the magic touch to pick all the right stocks and make you rich. It's a really powerful story, and honestly a super tempting one. But is that genius real? Or is it just a myth? Well, that's exactly what we're going to dig into. And the source material for this explainer, it pulls no punches. It gets right to the point with the singer. It's not just questioning the myth. It's out to prove that these high-flying, supposedly brilliant money managers consistently fail to do the one job they're paid for, to beat a simple, boring, totally automated investment. So how is that even possible? And really, this is the big question you have to ask yourself. When you hand your money over to one of these experts, what are you really getting? Are you paying for a guaranteed edge, for proven, repeatable skill? Or are you just paying for a great story, for a feeling of confidence, for the promise of genius? Okay, to get to the bottom of this, we've got to understand the two basic playbooks in the investing world. Think of it like two totally different sports, each with its own rules and its own way to win. You've got the active team on one side and the passive team on the other. This right here cuts straight to the heart of it. In the active corner, it's all about the hero's journey. The goal is to be smarter than everyone else, to beat the market by finding that needle in the haystack, that one winning stock nobody else sees. But over in the passive corner, the goal's a lot more humble. It's like, hey, let's not try to be a hero. The goal is just to match the market by owning a tiny piece of everything. So with active management, you're paying for a whole operation. We're talking a team of experts with fancy degrees, digging through research, analyzing spreadsheets, and making these big, bold bets. You're hiring their brain power, their experience, and yeah, even their gut feelings, all in the hope that they'll pick more winners than losers. Passive management, though, is the total opposite. It's the ultimate set it and forget it play. There's no star manager trying to outsmart the world. It's basically a computer-driven approach that throws its hands up and says, look, I have no clue what the next big thing is, so I'm just going to buy a little bit of everything. The goal isn't to be a rock star, it's just to ride the overall market wave. Now, just to be clear about who we're talking about, for this discussion, we're focused on mutual funds. Our source calls them investment clubs for regular folks, and that's a pretty good description. It's the kind of stuff most of us can invest in. We're not getting into the wild world of hedge funds. That is a whole other can of worms for the super rich. Okay, so if it's not always about how smart the manager is, what's really going on here? Well, this is where the plot thickens, because it turns out there's a hidden force at play, a kind of villain lurking in the fine print that has a massive impact on your money, no matter how brilliant your manager is supposed to be. And there it is, the single most predictable, most important factor in how your investments do over the long haul isn't some genius strategy. It's the fees. It's the price you pay. We've all heard the line, past performance is no guarantee of future results, right? Well, you know what is guaranteed? The fees. Every single year. To pay for that whole team of experts and their research and their fancy offices, an active fund charges you an annual fee. A pretty typical one is about 1% of your investment. Now, 1%, that sounds tiny, right? A penny on the dollar. But as you're about to see, it's a huge, huge hurdle to overcome. Now, look at the other side. Because a passive fund is pretty much on autopilot, its fee is microscopic. We're talking as low as 0.05%. I mean, just look at that difference. That's not a gap, that is a canyon. Our source puts it perfectly right here. You should think of bees as a constant headwind, always pushing against your portfolio. It doesn't matter if the market goes up or down. It doesn't matter if your manager hits a home run or totally strikes out. That fee is getting skimmed right off the top. It's a guaranteed loss you have to make up just to break even. So let's put some numbers on this. Imagine both funds have a great year and make you $1,000. On the active fund, that 1% fee takes $10 right off the top. Poof, gone. Now, the passive fund, that tiny fee takes 50 cents. So the passive investor is already $9.50 ahead before the so-called genius even has a chance to prove they're worth the extra cost. So let's bring this all home. This isn't some big Wall Street conspiracy or a secret code you need to crack. It all just boils down to some very simple but very powerful math. And this is the absolute key takeaway. For that active manager to be worth their high price tag, they don't just have to beat the market. They have to beat the market by more than their fee, just to tie the boring passive fund. Think about it. If the market goes up 8%, the passive investor gets pretty much all of that. The active manager needs to get a 9% return,
just for their client to get that same 8%. They're starting the race from behind, and the data shows that consistently clearing that hurdle year after year is just incredibly rare.
Which leaves us with one final thought. The next time you're looking at an investment that's promising you the moon, what's the first thing you should look for? Is it the big, flashy number they put in the brochure about past performance? Or is it that tiny little number tucked away in the fine print, the price tag that you are guaranteed to pay every single year? Thinking about that might just be the most important investment decision you make.